Welcome to the third section of partnership accounting basics. In the earlier two sessions, we have discussed about the basics of partnership. What are some of the ground rules for accounting for partnership? Then in the second session, we have covered treatment of capital and treatment of drawing, interest on capital and interest on drawings. Now, in this final session of basics of partnership accounting, we will talk about some other calculations like commission to a manager or commission to a partner, what are the different scenarios and how those calculations are done. And we will also talk about past adjustments. So let's begin with other calculations. Some of the other calculations, as I mentioned earlier, one is commission payable. So sometimes the manager or a partner is allowed a certain percentage of net profit as commission. The amount of commission can be mentioned in terms of amount clearly in the question, or it can be mentioned in terms of percentage of net profit. Now, when the amount is given clearly in the question, then obviously there is no requirement to do any further calculations and you can just treat it appropriately, either in the profit and loss account or profit and loss appropriation account, and solve the question. But if the amount payable to the manager or partner as commission is mentioned in form of percentage, then we need to do some calculations. And there can be two scenarios. The first one is on the profits before charging any payable commission. That means the commission would be payable to the partner or to the manager before charging any such commission which is payable. And the second scenario is on the net profit after charging any payable commission due to partner or the manager as per the partnership deed. So in both the scenarios, the formula for calculation is different. For first scenario, in order to calculate the amount payable to the manager or partner as commission, when such commission needs to be calculated before charging any payable commission, the formula would be net profit multiplied by rate of commission divided by 100. And in the second scenario, when the commission payable to the partner or the manager needs to be calculated after charging any payable commission, the formula would be net profit multiplied by rate of commission divided by 100 plus rate of commission. To understand this concept better, let's look at an example. Profits before charging commission payable to manager is rupees 22,000. So this is the net profit. And commission payable is at the rate of 10%. And this commission is payable before charging any such commission. So in this case, the formula that we would use is net profit multiplied by rate of commission divided by 100. So when we put the figures in the formula, so 22,000, that is the net profit, multiplied by 10, that is rate of commission, divided by 100. So the amount that is payable to the manager as commission works out to rupees 2,200. Whereas in the second example, the profit before charging commission payable to the manager is 22,000, same as above, and the rate of commission payable is 10%. The only difference in these two examples is, in first case, the commission is payable before charging any such commission. And in second example, the commission is payable after charging any such commission. So in second scenario, the formula that we would use is net profit multiplied by rate of commission divided by 100 plus rate of commission. So 22,000 multiplied by 10 divided by 100 plus 10, because the rate of commission is 10%. So the amount that we have computed, which is payable to the manager as commission, comes out to 2,000. So this is the difference between the amount for commission payable before charging any such commission or commission payable after charging any such commission. So these are the two scenarios which you may come across in any question. There are a couple of things that you should keep in mind. Commission to manager would be written in profit and loss account and not in profit and loss appropriation account. But commission payable to the partners would be written in profit and loss appropriation account and not in profit and loss account. In absence of information, managers or partners' commission would be calculated on profit before any adjustment is made according to the partnership deed. That is before adjustment in respect of partner's salary, interest, or capital, etc. In other words, managers or partners' commission would be calculated on corrected net profit of the profit and loss account if the question is silent. That means if the question is not mentioning that whether the commission payable to the partner needs to be calculated after doing any adjustment in regard to salary or interest on capital or interest on drawing or anything, then whatever amount is disclosed by the profit and loss account as net profit, we will consider that amount for our calculations. Manager's commission is charged against profit and not an appropriation of profit. The commission which is payable to the manager is charged against profit. And as discussed earlier, all the charges against profits would be recorded on the debit side of profit and loss account and not in profit and loss appropriation account. Whereas the partner's commission is an appropriation of profit and not a charge against profit. Hence, it is debited to profit and loss account and not to the profit and loss appropriation account and not to the profit and loss account. Another calculation is for loan to the firm by a partner. If a partner gives a loan to the firm, he is entitled to receive an interest on such loan at an agreed rate of interest. At times, what happens is the firm may be in need of some temporary amount. So rather than arranging for that funds from some financial institutions, the partner may advance that amount to the partnership firm as loan, which is over and above his capital. And this is not part of capital, or this is not in addition to the capital. This is a separate amount that the partner has provided to the partnership firm as a loan. So whenever we are taking any loan from outside the business, from any financial institution or a bank or any of our creditor, then obviously we will pay an interest on that loan. Likewise, the loan from the partner is also entitled to receive interest on that loan. If the partnership deed clearly calls out that at what rate the interest would be provided to the partner if he advances some loan to the partnership firm, then the interest on partner's loan will be provided on that rate. If the partnership deed is silent in regard to whether the interest should be provided on the loan advanced by the partner to the partnership firm, or if it is silent about the rate at which the interest on loan should be provided, then as per the provisions of Indian Partnership Act, the partner is eligible to get interest on the loan advanced to the partnership firm at a rate of 6% per annum. So even if the partnership deed is silent about interest on loan to the partnership firm by the partner, then also the partner is eligible to get a interest of 6% per annum on the amount of loan advanced to the partnership firm by the partner. Nature of interest, as I shared with you earlier, interest on partner's loan is charged against profit, and hence such interest is allowed whether there is profit or not. So the partnership firm don't have a choice that whether to pay interest or not. Yes, they have a choice in terms of whether to pay it during this accounting period or the following accounting period, but they cannot deny the payment of interest on loan to the partnership firm by the partner. They have to provide the interest either at the agreed rate or at the rate of 6% per annum. And as this is a charge, it will be shown in the profit and loss account and not in the profit and loss appropriation account. Because as we discussed earlier, all the charges, no matter again under what name the charges are, but all the charges would be debited in the profit and loss account and not in the profit and loss appropriation account. Interest on partner's loan is not credited to partner's capital or current account. It is credited to partner's loan account. Remember, this is very important because the loan which has been advanced by the partner is not part of his capital. So accounting for partner's loan would be treated separately from the partner's capital account or partner's current account. So any loan which is provided will have a separate account in the books of account, and the interest provided on partner's loan would be credited to partner's loan account. Now, at time when the partner has advanced the loan, there can be two scenarios in this regard, which we have discussed, that whether to provide the interest or not, and if yes, then at what rate, or the scenario can be the partnership deed is silent. So if the partnership deed calls out that yes, the interest needs to be provided and at what rate the interest needs to be provided, the interest would be calculated on the agreed rate. But if the partnership deed is silent in regard to whether the interest needs to be provided or not, and if and at what rate, then the partner is eligible to get an interest at the rate of 6% per annum. And as shared earlier, interest on partner's loan will be written in the profit and loss account on the debit side, as this is an expense for the firm and would be treated like any other expense charged against profit of the partnership firm. If we talk about accounting treatment, it will be appearing in the profit and loss account and will be credited to partner's loan account. And the journal entries that we need to pass is for providing interest on partner's loan, we will debit interest on partner's loan account and credit partner's loan account, because all the expenses, because the interest which is paid to the partner on partner's loan is an expense for the firm, so it is debited. And when we are providing interest, then the balance of partner's loan account will increase. So that's why partner's loan account is credited. And for closing the interest on partner's loan account, the profit and loss account would be debited and interest on partner's loan account would be credited. So thereby closing the interest on partner's loan account, because again, it is a nominal account and balances of all the nominal accounts are transferred either to the trading account or profit and loss account at the end of the accounting period. Moving further, there may be some scenarios where interest on loan needs to be charged that is provided to the partner by a firm. Depending on the situations and circumstances, the firm can also advance some loan to the partners. And interest can be charged on such loans only when there is a clause in partnership deed calling out the rate at which interest can be charged on such loan. If the partnership deed is silent about the rate at which the interest needs to be charged on the loan advanced by the partnership firm to the partner, then no interest can be charged. And the Indian Partnership Act is also silent in this regard. So if the partnership firm has advanced a loan to the partner, then interest on that loan can only be charged if it is agreed in the partnership deed and at the agreed rate in the partnership deed. If there is no such provision in the partnership deed that if the partnership firm has advanced any loan to the partner, then interest needs to be charged on it, then no interest can be charged on the loan advanced by the partnership firm to the partner. Interest on loan to the partner by firm will be credited to P&L account, as this is an income for the partnership firm and will be treated like any other income, and this will be added to the profit of the partnership firm. If we talk about the accounting treatment, then first of all, rate of interest, it will be as per the agreement in the partnership deed. If there is no agreement for charging interest, and the partnership deed is also silent about the rate of interest at which the interest needs to be charged on the loan to the partner by the partnership firm, then no interest can be charged. And this interest on loan taken by the partner is gain or income for the partnership firm, so it will be credited to profit and loss account. If we talk about accounting treatment for the following entries are passed. For charging interest on loan to the partner, partner's capital or current account would be debited and the interest on partner's loan would be credited, because the interest on partner's loan would be an income for the partnership firm. And for closing the interest on partner's loan account, interest on partner's loan account would be debited and profit and loss account would be credited, because interest on loan advanced by the partnership firm to the partner is an income for partnership firm. That's why profit and loss account is credited. And again, interest on partner's loan account is a nominal account. So we will close the balance of interest on partner's loan account by transferring it to the profit and loss account, and just like any other nominal account. Rent paid to partner. At times, partner allows the firm to use its property, that is shop, warehouse, machinery, car, or any other fixed assets, and charges rent from the firm for its usage. Any such rent paid to the partner will be written in the profit and loss account, as this is an expense for the partnership firm, and it will be treated like any other expenses charged against the profit of the firm. If we talk about accounting treatment, rent payable to the partner by the firm will be debited to the profit and loss account and will be credited to partner's current or capital account. And the journal entries that we will pass is for providing rent to a partner, rent partner's asset. If to make it clear, you can mention what asset is being used. That is rent for shop, rent for warehouse, rent for machinery, car, or so on and so forth, to partner's capital or current account. And for closing the rent account, the profit and loss account would be debited and rent to partner's asset account would be credited, because rent to on partner's asset is again a nominal account, and the balance of nominal account is closed by transferring it either to the profit and loss account or to trading account. So these are the accounting entries for rent paid to a partner for any of the asset which has been used. Now, there may be scenarios where the appropriations are more than the profit. When the appropriations are more than the profits, then the profit is available for distribution will be distributed in the ratio of appropriations. And how this ratio of appropriations is applied and how the appropriation is worked out and how the profit is distributed among the partners in the ratio of appropriation, we will understand with the help of this example. A and B are partners sharing profit and loss in the ratio of 2:1. A is a non-working partner and he has contributed 12 lakh as his capital. B is working partner. Remember in our first session, we spoke about active partner or the managing partner versus dormant or sleeping partner. So in this example, A is our dormant or sleeping partner and B is our managing or active partner. So the partnership deed provides for an interest on capital at the rate of 10% per annum and salary of rupees 7,500 per month to the working partner. So that means both the partners will get interest at the rate of 10% per annum and a salary of rupees 7,500 per month will be given to the working partner, that is B. The net profit for the year ended on 31st of March 2016 before providing interest on capital and salary amounted to rupees 70,000. You are required to show the distribution of profit. Now, let's do the calculations. First of all, we need to calculate the amount that we need to pay to both the partners. So here, if we talk about interest on capital, B has not contributed any amount as capital, so he will not receive any interest on capital. Whereas A has invested 12 lakh rupees as capital and the rate of interest on capital is 10%. So A is supposed to get 1,20,000 as interest on capital. If we talk about salary, the salary per month is rupees 7,500 for the active partner, that is B, and A is not supposed to get any salary. So B is supposed to get 90,000 as salary and A is supposed to get 1,20,000 as interest on capital. So the total claims against profit or the total amount payable to the partners as per partnership deed, either in form of interest on capital or in form of salary, comes out to 2,10,000. Whereas the profit earned by the firm for the accounting period is only 70,000. Now we need to do the calculation of appropriation. So what we will do is we will find out the ratio of the amounts that is payable to the partners. So the amount due to A is 1,20,000 and the amount due to B is 90,000. And when we solve the equation, the ratio of amounts payable to both the partners comes out to 4:3. So now what we will do is amount available for distribution is 70,000 and we will distribute this amount between A and B in the ratio of appropriation. The ratio of appropriation means the ratio in the amounts that is payable to each partner. So this 70,000 is distributed between A and B in the ratio of 4:3. So A will get 40,000 rupees and B will get 30,000 rupees. So this is how the appropriation is done when the amount that needs to be paid to the partners, the total amount that needs to be partners on account of different claims, that is interest on capital, salary. Here we have only two things, that is interest on capital and salary. If there would have been commission or some other charges, then this amount would have changed. So when the amount, this is how the amount available for distribution is divided or appropriated among the partners in the ratio of appropriation. Moving further, at times, in partnership firm, a guarantee of profit is provided to a partner. And this partner, this guarantee to a partner for the profit can either be given by one partner or all the partners in a particular ratio. So when the profits of firm are not adequate, then the excess paid to the guaranteed partner should be charged to the partner who has given the guarantee. Let's look at this example to understand it better. Aman, Babita, and Suresh are partners in a firm. Their profit sharing ratio is 2:2:1. However, Suresh is guaranteed a minimum amount of rupees 10,000 as share of profit every year. Any deficiency arising on that account shall be met by Babita. That means whatever profits this partnership firm of Aman, Babita, and Suresh will earn, that will be distributed among all these three partners in the ratio of 2:2:1. However, Babita assured Suresh that in any case, his share of profit will not be less than 10,000. And if in any case, the share of profit for Suresh is less than 10,000, then the deficit would be paid by Babita. So for example, in case, if the amount of share in profit for Suresh is 9,000, then there is a deficit of 1,000. So that 1,000 would be paid by Babita to Suresh. Further, the profits for the 2 years ending on March 31st and March 31st, 2017 and 31st of March 2018 were rupees 40,000 and 60,000 respectively. Prepare profit and loss appropriation account for the 2 years. So first of all, let's prepare the profit and loss appropriation account for the year ending on 31st March of 2017. So this is the profit and loss appropriation account, and the working note is presented here. So first of all, let's understand the working note. The partners are Aman, Babita, and Suresh. Their profit sharing ratio is 2:2:1, which the total comes to 5. Profit for the year is 40,000. So this 40,000 would be divided among Aman, Babita, and Suresh in the ratio of 2:2:1. So when we calculated their share in profit out of 40,000 in the ratio of 2:2:1, it comes out to 16,000 for Aman, 16,000 for Babita, and 8,000 for Suresh. But remember, Babita has given an assurance to Suresh that in no case his share of profit can be less than 10,000. But here, his share of profit is 8,000 only. So what we will do is, we will deduct 2,000 from Babita's account and we'll add this 2,000 in Suresh account. So the share in profit for Suresh can be rupees 10,000. So that is the reason here the net profit of 40,000 has been distributed among the partners as 16,000, because Aman has not given any assurance. So Aman will get his entire share of 16,000, which is has been worked out as from the total profit of 40,000. Whereas Babita initially his share, her share of profit was 16,000, but as we have deducted 2,000 from her account, so she will get only 14,000 as her share of profit. Whereas Actually, Suresh was supposed to get only 8,000 as his share of profit. But because of the assurance given to Suresh by Babita, his share of profit has been increased to 10,000 from 8,000 by adding 2,000 from Babita's account. The minimum account, the minimum guaranteed amount to Suresh is rupees 10,000, whereas his share of profit as per profit sharing ratio worked out to be rupees 8,000 only. Hence, the shortfall of rupees 2,000 will be borne by Babita. This is as per the agreement among the partners. Now, let's go ahead and prepare the profit and loss appropriation for the second year, that is year ending on 31st of March 2018. And in this year, the total profit earned by the partnership firm was of rupees 60,000. So when we prepare the profit and loss appropriation account, this is how it should look like. But let's look at the working notes. Again, the same partners, same profit sharing ratio, but this year the profit has been rupees 60,000. So when we distributed this 60,000 among the partners in the ratio of 2:2:1, their share in profit is coming out to be 24,000, 24,000, and 12,000. Because the share of Suresh is more than 10,000, that is the guaranteed amount. Hence, there is no need for any adjustment, and all the partners will get their due share in profit as per the agreed ratio. So that's pretty much about some of the calculations that we need to understand in addition to the maintaining of partners capital account, maintaining partners maintaining partners drawings account, calculation in regard to interest on capital, or calculation in regard to interest on drawings. So let's go back to our content, and now we come to the last section of this session. And in this last section, we will talk about some past adjustments. So what are the past adjustments, or why the past adjustments are required? Sometimes a few omissions or errors in recording the transactions or preparation of summary statements are found after the final accounts has been prepared and the profits are distributed among the partners. And the omissions or errors may be in regard to interest on capital, interest on drawings, interest on partners loan, partner's salary, partner's commission, outstanding expenses, changes in provision of partnership deed, or system of accounting having impact with retrospective effect. Retrospective means like something that that needs to be changed in past. So at times when the partners accounts are prepared, either couple of things are omitted or some errors have been done in the calculation. So when those errors or omissions has been detected, then we need to do some past adjustments. Now, all these acts of omissions and commissions needs to be adjusted for correction of their impact. One option is you go back and rewrite your books of accounts, which is obviously going to be a very tedious method. So rather than going and rewriting the books of accounts and preparing the final accounts again, we can make the necessary adjustments by either of the following ways. The first is directly in the capital account of the concerned partners, because it is not necessary that capital accounts of all the partners or current account of all the partners may get impacted because of the error. Maybe there are 4 partners. Out of those 4 partners, only accounts of 2 partners are getting impacted. So we can make the adjustment or correcting entries in the capital accounts of the concerned partners by passing a compound entry. And you know, when more than 2 accounts are involved in a journal entry, it is termed as compound entry. The second option is directly in the capital accounts of concerned partners, passing individual entries or normal entries where only two accounts are involved in a particular journal entry. And the third method is through profit and loss adjustment account. So these are the three ways of making the past adjustments. When you are making the adjustments in partners capital account directly, then effect or impacts of various past adjustments are taken into consideration, and the net impact of all the adjustments is worked out. By net adjustment, suppose a partner was supposed to get rupees 5,000, but he only received 3,000. So that means the capital account of this partner needs to be credited by 2,000. On the contrary, one partner was supposed to get 3,000, but he received 5,000. So capital account of that partner needs to be debited by 2,000. So we will debit the account of one partner and we will credit the account of another partner. So this is how we calculate the net impact. And once the net impact of all the adjustments is worked out, one compound journal entry is posted to pass the net impact of all the adjustments. Secondly, if we follow the profit and loss adjustment account, effect and impact of various past adjustments are calculated, worked out separately, and adjustment or correcting entries are passed using profit and loss adjustment account. How this is done, that is something we are going to discuss in following slides. So the example is X, Y, and Z are partners sharing profit and losses in the ratio of 3:2:1. After final accounts have been prepared, it was discovered that interest on drawings at the rate of 5% has not been taken into consideration. And the drawings for the partners were X withdrew 1,50,000, Y 1,26,000, and Z 1,20,000. So now we need to pass the necessary adjustment journal entry. So in order to pass the necessary journal entry using the compound entry method, what we will have to do is first we need to work out that what was the amount that firm was supposed to get from each partner as interest on drawings. So for X, it is 3,750. For Y, it is 3,150. And for Z, it is 3,000. So the total amount that the partnership firm was supposed to receive as interest on drawings was 9,900. And this 9,900 was supposed to be distributed among the partners in ratio of 3:2:1, which is their profit and loss sharing ratio. So when this 9,900 is distributed among the partners in the profit sharing ratio, then X is supposed to get 4,950, Y is supposed to get 3,300, and Z is supposed to get 1,650. But here what happened was the interest on drawings was never being charged. So Z in one way or other way has received 3,000 extra. Z has received 3,000 against 1,650. So he has received 1,350 extra. Y is supposed to get 3,150, but he was supposed to receive 3,300. So he has received 150 rupees less than what he is supposed to receive. And X was supposed to receive 4,950, but has received only 3,750, which is 1,200 less. So now we will pass the adjusting journal entry, a compound journal entry. So as Z has received 1,350 extra, so what we will do is we will debit Z's account with rupees 1,350 and will credit X account with 1,200 and Y's account with 150 to make the adjustments. Taking the same example, same calculations, if we need to pass individual correcting entries, then what we will do is we will pass two journal entries. First, we will debit Z's account and credit X account with 1200 rupees. And then in the second entry, we will again debit Z's account with 150 and credit Y's account with 150 rupees. Now, the third situation or the third solution that we have for this correcting entry is using the profit and loss adjustment account. So here, first of all, what we will do is we will debit C's capital account and credit profit and loss adjustment account. That means the excess amount that we have paid to C, we will bring it back to profit and loss adjustment account. And as we have paid 1,350 extra to Z, that is the reason we have debited C's capital account and credited profit and loss adjustment account. Now, we need to credit X and Y's capital account. So that's the reason we have again debited the profit and loss adjustment account and we have credited X and Y's capital account as per our working. That is, X is supposed to get 1200 more, Y is supposed to get 150 more. So this is how we can make the past adjustments either by using a compound journal entry or simple journal entries or by using the profit and loss adjustment account. Next thing is, at times we may have to calculate the opening balance of the capital. So how that calculation is done, let's try and understand with the help of an example. A and B are partners sharing profit and loss in ratio of 3:1. Their capitals at the end of financial year 2017-18 were rupees 6 lakhs and rupees 3 lakhs. During the year 2017 and 18, A withdrew 80,000 and B withdrew rupees 40,000, which was duly debited to partners' capital account. Profit before charging interest on capital for the year was rupees 80,000. The same has been credited in their profit sharing ratio, that is 3:1. B has brought an additional capital of rupees 70,000 on October 1st, 2017. And now we need to calculate the interest on capital at the rate of 12% per annum for the year 2017 and 18. So for this, we will have to first calculate the opening balance of capital and how we are going to do that. First of all, capital at the end of the financial year, that is 31st of March 2018. For A, it is 60,000, 6 lakhs, and for B, it is 3 lakhs. Now, the drawings we will add, which was previously deducted, that is 80,000 for A and 40,000 for B. Now, we will deduct the amount of profit which has already been credited to partners' capital account. And the profit for the year ending on 31st of March 2018 was rupees 80,000, and that was supposed to be distributed among the partners in the ratio of 3:1. So the amount of profit that A has received is 60,000 and the amount of profit that B has received is 20,000. So we have deducted the 60,000 and 20,000 respectively from the closing balance of A and B. Now, B has brought an additional capital of rupees 70,000 during the year. So we have again deducted that 70,000 from the closing balance. Whereas A has not made any alteration in his capital contributed, so we will not make any adjustment. So this is how we arrived at the opening balance of capital accounts for A and B. For A, it stands at rupees 6,20,000 and for B, it stands at 2,50,000. Now, we need to calculate the interest on capital at the rate of 12%. So for A, as there is no change in capital during the year, that is addition or deduction, so we will provide interest at the rate of 12% on entire 6,20,000 for the entire year, which comes out to 74,400 for 12 months. Sorry, there is a typo. But for B, we will provide interest on capital for 2,50,000 for 12 months, which comes out to 30,000, and for 70,000 we will provide for 6 months, because A has brought additional capital of 70,000 on 1st of October 2017. So for that amount, we will again provide interest of 12%, but just for 6 months. So for interest on B's capital comes out to 34,200 in total. Now, if we will have a look at another question in which we need to prepare the profit and loss appropriation account. So Aarti and Bharti are two partners in the firm sharing profit and losses in the ratio of 3:2. The following trial balance was extracted from the books as at 31st of March 2020. So this is the trial balance of the partnership firm for Aarti and Bharti. Taking this trial balance into consideration, first of all, we are required to prepare the trading account, then profit and loss account, and finally the profit and loss appropriation account. And after preparation of profit and loss appropriation account, we also need to prepare the balance sheet. And in order to prepare all these accounts and balance sheet, we need to take following information into consideration. The closing stock was valued at rupees 60,000. Rent for the month of March 2020 has not been paid. Depreciate computers by 20%. Bharti is allowed a salary of rupees 5,000 per month, and partners are entitled to interest on capital at the rate of 6% per annum. So considering all these adjustments and trial balance, first of all, we will prepare the trading account. So as per the trading account, the gross profit that the partnership firm has earned is rupees 3,20,000. We will transfer this gross profit of 3,20,000 to P&L account. And after making provisions or adjustments for all the charges against profit, that is rent, salary, journal charges, and depreciation on computers, the net profit that the partnership firm has earned for the accounting period stands at rupees 1,37,000. And this rupees 1,37,000 is transferred to profit and loss appropriation account. Now here in profit and loss appropriation account, we are not taking interest on drawings into consideration, because as per the partnership deed, there is no mention of interest on drawings. Then we have allowed a salary of rupees 60,000 to Bharti, because as per the partnership deed, Bharti is entitled to get a salary of rupees 5,000 per month. Then interest on capital needs to be provided. So we have accounted for interest on capital, that is 18,000 and 9,000 respectively for Aarti and Bharti. Then after deducting this 87,000 from 1,37,000, the net amount that is available with us for distribution among partners is rupees 50,000. So remember, this 50,000 is the divisible profit, and we have distributed this profit among Aarti and Bharti in the ratio of their in their profit sharing ratio, that is 3:2. Now after this, we will prepare the balance sheet, and here we have shown the capital accounts of both the partners separately. And we have shown the other liabilities, that is sundry creditors and outstanding rent. So the value of sundry creditors is coming from the trial balance, and outstanding rent is coming from the adjustment where it was mentioned that rent for one particular month was outstanding. And rest of the details are coming from the trial balance, except for the depreciation on computers, which is coming from the adjustments. So this last example that we have discussed was end-to-end solution for a preparation of final accounts for a partnership firm. So that's pretty much from our side on in this series of accounting for partnership basics. We will come up with another series in which we will discuss other aspects of partnership accounting. Hope you have liked these 3 videos in this session. And if you have any comments, please feel free to leave your comments. Thank you.